Joining us now is Pictet Asset Management Head of Emerging Debt, Simon Lou Fong. And we appreciate you dropping in on your way to an IMF meeting, so you spent a little time with us. What do you think about the hunt for yield right now? Is it back on, or in the last couple of days are people starting to freak out because of this kind of taper tantrum story?
I think it's definitely been back on since February, so you've seen a very big rally since then. I think it's also been connected with a improvement in fundamentals in emerging markets, and at the same time you've seen the currencies stabilize and then start to rally. So you've seen big returns in local currency debt of up to 16 to 17% this year.
And Pictet has been the biggest beneficiary of that EM debt inflows, $2.6 billion this year. Tell us more about this inflow. Is it all institutional investor money?
It's a mixture between what we call institutional and wholesale. I think that the aspect of searching for yield is across many different types of investors. So to that extent, everybody is searching for yield in the safest possible way.
And why is that? Is it because you're looking to be more risk adverse than others? I mean, what's the distinction of a Pictet approach versus someone else?
Sure. Yeah, I think that we've been one of the first to have a dedicated emerging market local currency fund. So I think that helps. We've got a good track record over some difficult periods. And then obviously at the end of the day, people look at your relative returns to the benchmark. And I think we've done, in the difficult periods, we've done relatively well compared to the competition.
So if I look at the Bloomberg Barclays indexes, the obviously year-to-date return is good for fixed income across the board, but the only ones to get above 10% return are high yield indexes and EM. If I show a spread on the Bloomberg between the U.S. dollar-denominated emerging market debt aggregate index and the U.S. Ag, sort of the main benchmark for debt in the U.S., you can see that emerging markets have outperformed considerably. Is it ready to take some money off the table here?
Sure. I would probably argue that the Fed tightening cycle that we're in at the moment, the difference between in December 2015 when the market got very nervous is that we know we're in that cycle already, and there's a little bit priced in for some more. So I think that, you know, the tapering which happened in 2013, the start of the Fed rate hike in December 2015, I think to that extent, you know, we're kind of prepared for that. So I think that as long as the fundamentals remain on a reasonable track, i.e. that growth now starts to look like it's picking up in certain areas, then I think we'll see people sticking with the trade.
But would Fed tightening throw a wrench in that EM stability?
Well, I think the first one definitely had people sort of, they were worried, they didn't know how much or when it would be. But now we expect this year, certainly, potentially there to be another one this year. So to that extent, it's priced in.
We talked about the inflows that have come in. Is it difficult to deploy all that new investment? Because a lot of people worry that they might have missed the boat, that the easy gains have been made already.
Sure. Yeah, I mean, I think it's going to be difficult to see 17 or 18% returns, which we've seen this year, because part of that return was the fact that we had sold off quite aggressively last year. So I definitely feel that, yeah, it's hard to see that again. But I do think that we can see returns potentially in the region of like 7 to 8% in the next 12 months.
But what about, I mean, when I talk to other big fund managers like Howard Marks, who's in distressed, obviously it's different, but when he raises billions of dollars, it's not easy for him to spend all that money. He has to keep a large portion of cash. So you've raised a ton of money this year. Do you keep a lot of it in cash, maybe more than you do normally, because it's not there's just not enough supply out there?
Sure. No, there's definitely been enough supply for us out there, and we've managed to invest that in the markets without any increase in spread or transaction costs. So that bit actually has not been a problem.
What do you think about the U.S. election and how that factors into how you deploy your cash? Because so much of EM now is hinged on what the Fed does and the macroeconomic environment. And of course, the Fed, as Neel Kashkari likes to say, Minneapolis Fed president.
He says it's not political.
It's not political, but the Fed clearly is not going to do anything in November before the November elections.
Right. Yeah, I mean, I would say if you try and decompose the returns of EM fixed income, somewhere between 30 and 50% of the returns can be determined by non-EM specific factors, such as the Fed or the upcoming political elections here. I think that, you know, our process, though, is sort of robust enough to cope with that, and we have a part of the process called the top-down, which looks at non-EM factors, and we'll definitely be watching those closely and adjusting the portfolio accordingly.
But would one candidate or the other be better for the stability of emerging markets?
I think that, it's probably bigger than either candidate. I mean, the sort of macro tailwinds and the policy making, which is going on at the moment, is probably bigger than any single individual. So I suspect actually that when we look back, and I'm from the UK where we've had Brexit recently, that we'll probably see financial markets maybe get a little bit nervous coming into it. You have some reaction after the result, and then I think financial markets will settle back down.
And of course, Brexit is one political risk in the developed world. The U.S. elections is another. In the emerging market world, how do you see political risk playing out in places like Latin America?
Sure. I think actually in a positive way, because what we're seeing in Latin America is we're sort of a move from the sort of left socialist sort of side into a more centrist sort of pro-growth. You're seeing that in Argentina with Macri. You've seen it in Brazil after Dilma left. And potentially the big one would be to see some positive change of normalization in Venezuela.
Yeah, that's the big one for sure.
Simon, really great to get some time with you. Fascinating stuff to talk about. Thank you so much.
Thank you.
Simon Fong, they're head of emerging market debt at Pictet Asset Management.